at Investment TV. In this episode, we're going to take a look at gun maker Smith & Wesson. So the first thing that I thought stood out with Smith & Wesson is it has had some ups and downs. The company really struggled a lot in the early aughts. The stock surged around 2005 to 2007 before crashing in the financial crisis. But if you bought in from 2009 to 2012, you've made out very well. The only question is it still a good investment in 2015? Smith & Wesson's doing a lot of good things right now, and that's one reason I thought I'd take a look at them. And one of them is the SWHC line of guns, and these are modeled after Glocks. Now, this is the successor series to the Sigma, and the Sigmas were not very popular. They were very criticized, and so Smith & Wesson's response was the SWHC, and I've seen very good reviews of these online. If you want to see a little bit more about them, I recommend Hitchcock45's YouTube channel. Just enter Hitchcock45 and SD9VE. You should get at least a video or two on the gun. And I think a lot of gun owners really like this gun, whereas the Sigma series, not so much. So this has been a very good selling gun, and it's a lot less expensive than the Glock 19, even though it's very similar. Now, another big seller for Smith & Wesson is the M&P Shield. This is also the SWHC. I found some of those around $320, $330 here in Atlanta, whereas the M&P Shield is probably going to cost you a little over $500. But both of these lines of guns have been very big sellers for Smith & Wesson on the consumer front. So let's jump into the financials for Smith & Wesson, and the first thing we're going to look at is the normalized operating income, and you can see major improvement on this front. Back in 2004, Smith & Wesson was at about $5.9 million in normalized operating income and about $7.5 million in normalized EBITDA. Now, fast forward to 2014, that figure had jumped all the way to $151 million for operating income and $173 million for EBITDA. Now, 2012 to 2014 was a bit of a boom, so there's a little bit of a decline in 2015, but it still looks very good, comparatively speaking, at about $90 million in normalized operating income and $121 million in normalized EBITDA. Next, let's look at the operating margins for Smith & Wesson, and once again, you can see major improvement there. 4.9% in 2004, tended to be below 9% 2004, 2005, 2006, and then after about 2010, Smith & Wesson's put up some pretty good numbers. 2011 was a bit of a down year, but over the past 4 years, they've been in the 11% to 24% operating margin range, which is spectacular. Now, part of that's probably the gun buying boom from 2012 to 2014, but even in 2015, the numbers look very impressive at 16%. Next, let's take a look at what I call normalized income, and also dramatic improvements on this one. $13 million in 2011. That jumped to $100 million by 2014 now. Similar to the operating income and margins, it fell a little bit in 2015, but it's still in very good shape overall. Now, the big question when looking at these numbers, the 2015 financial results sustainable? Is this a new normal, or will we see more reversion to the mean? And it's a fair question to ask because from about 2012 to 2014, we had a gun buying boom. And that's not going to continue indefinitely, I don't think. So we'll see margins normalize. The question is just how much further do they have to go, and how much of this is what you would call maybe real improvement at Smith & Wesson. Now, one thing, this is not something I spend a lot of time analyzing with most companies, but with Smith & Wesson, I did. and this is the tax rate. Smith & Wesson's tax rate is one of the highest I've ever seen for a U.S. corporation. It's generally been in the 36 to 38% range. I normally see companies more around 25, 30%. And this one's even jumped up to 40% at times. So I'm not sure if there's anything Smith & Wesson can do to lower their tax liabilities, or if this is sort of where they're stuck. But it is something interesting to know. This is definitely a company, if we ended up getting corporate tax reform, would probably benefit immensely. Finally, let's just take a quick look at free cash flows. Similar story to the operating income and normalized income. We'll note that free cash flows are about $60 million in 2015, almost exactly the same as normalized income. So I think that's a pretty fair estimate of what I would call true profitability for Smith & Wesson in 2015. The only question is whether they can stay in that range or they're going to see further margin compression. Now it's time for the valuation with Smith & Wesson, and this is where I come a little bit skeptical of this stock. And I ran, I would call, two reversionary scenarios, and that assumes that the 2012 to 2014 boom, that's unsustainable. We'll continue to see further reversion away from that. So those are the first two scenarios. The next two are what I'd call maybe moderate growth scenarios. Basically, that 2015's a normal, we'll say normal year for Smith & Wesson, and that things will slowly improve, and they'll see the growth rate, a reasonable growth rate over the next 5 years before leveling off at 3% long term. And then the final scenario is what I'm going to call the boom scenario. And in this scenario, not only is 2015 not what you would call a unsustainable profit year, but we'll actually see profits grow significantly from that point. So they'll see a little bit of a boom even in the next few years under this scenario. Now you can see the results of these 5 different models, these 5 different scenarios I ran. And where I'm becoming very skeptical of this stock is even when I run the boom scenario, I can't come up with the current stock price. As I'm doing this video, it's about in the $15.50 to $16 range. And even in my boom scenario, it's only coming up at $15. I think a more realistic valuation for Smith & Wesson is probably around, we'll say maybe $11 to $12 range. So to me, I'm looking at this and it doesn't look like it has much of a margin of safety at all. Conclusions time, and I think Smith & Wesson's management has done a great job over the past few years introducing products that consumers like. They've done a great job at expanding margins, cash flows, and everything. It's just that I don't see the valuation as sustainable. I think that I would probably not buy this personally. I wouldn't even consider it unless it fell below 10, and I would advise people to keep away from it unless it fell back below 12 at all. If it fell below maybe 9 or 10 as a value margin of safety investor, I might get interested. But at $16, I think this is overvalued, even if the company continues performing on all cylinders. This thing's really priced at perfection right now. All right, thanks for watching. I'll see you next time.